What if I told you that selling and rolling a cash-secured put could lower your out-of-pocket costs, even if you get assigned in the money? In this video, I'll walk you through my SPY trade and show you exactly how this strategy helped me reduce my cost basis while staying in control. I'm Patricia Saylor, Managing Partner of Saylor Financial Fundamentals, here to show you once again how to boost your investment returns without unnecessary risk. Today is Wednesday, March 19th, and SPY is trading at $564 a share. I have a cash secured put with a strike price of $590 that is expiring in 2 days. This cash secured put is pretty deep in the money, and this setup looks like a problem because if I'm assigned to buy, I'm going to be paying about $2,500 more than these shares are currently worth. But let me show you why this is not really as bad as it seems. A little less than 2 months ago, on February 24th, SPY was trading at $601.30, and I decided at that point that I wanted to buy 100 shares. I could have spent $60,130 and bought 100 shares on February 24th, but the share price was pretty elevated and I expected it to pull back. So instead of buying the shares that day, I sold a cash secured put with a strike price of $590 that expired on March 7th. So it was an 11-day trade with $59,000 of capital, and I brought in $256.34. As I approached March 7th, the share price started to fall significantly, and it dropped all the way to $578. And I decided I didn't want to be assigned at $590, so I rolled the cash secured put out to March 14th. I received $174.68 for the roll, and as I approached March 14th, the share price continued to decline, and it dropped all the way to $568.49. I decided to roll the position again to bring in more income, and I rolled it out to March 21st. So this was a 14-day roll, still keeping the same $590 strike price, and I brought in $194.68, which brings us to where we are today. This put is expiring, and I have a decision to make about whether to accept assignment at $590 or roll it again. The purpose of this explanation, though, is to show you the benefit of having sold the put and rolled it a few times. Let's compare the two possible outcomes. Now, this is hypothetical. If on February 24th I had just bought those 100 shares, I would have paid $60,130 for them. My total out of pocket, $60,130. Divide that by 100 shares, and that comes out to the $601.30 per share. But let's compare that to where I'll be if I accept assignment on Friday, March 21st. Rather than pay that $601.30, I have sold a cash secured put for $256, rolled it for another $174, and rolled it again for $194.68. And if I'm assigned on Friday, I'll pay $590 a share. That will bring my total out-of-pocket expense to $58,374.30, or $583.74 per share. This number is still above the current share price, so my net liquidating value will be less than I have invested in the shares, but by selling the cash secured put and rolling it a few times before I accept assignment, I have reduced the cost basis of my shares by about $18 a share. And in the long run, as the share price recovers, I'm going to be in a lot better position than if I had just bought the shares outright. And that is the benefit of selling and rolling cash secured puts as a way to buy stock at a discount.